Chapter 5 covers inventories and cost of sales. Determining inventory costs. We've already discussed in a previous chapter that when we record inventory, we record it at the business's cost. So when the inventory was purchased, whatever the cost of the inventory is, that is the amount that we use to record inventory on the books. That does not just include the cost of the inventory itself, the actual products. You can take the invoice cost and then add a few additional costs to that to get the inventory cost that you'll record on the books. So basically, anything that brings the products to a saleable condition and location can be included in the total inventory cost. So we take the cost of the merchandise, which would be the inventory cost less any discounts. Then you could also add shipping, storage, and insurance costs to get the total inventory cost that you record on the books. Inventory is an asset, obviously, and it needs to be protected. So there need to be controls in place to protect inventory. Just like cash or other assets can be stolen, so can inventory. So there are a few different documents that can help to track inventory and make sure that the inventory that was ordered was actually received. So a purchase order is the document that authorizes inventory to be purchased. The receiving report is a document that you go through and check off to make sure that when a shipment arrives, all of the inventory that you actually purchased does come with the shipment. So making sure that you received everything that you ordered. The invoice is then from the vendor, which we've talked about before, from the supplier, and it shows what was purchased. So you want to make sure that all three of these documents agree before you record the inventory on the books. Some additional internal controls, other than those three documents that we just talked about. First of all, most companies take a physical inventory count. So for instance, when you go to a retail store, or if you've ever worked retail and you talk about inventory, what they're referring to is the physical count of inventory to make sure that they get a count of the inventory that actually exists, and then they adjust the inventory number on the books to match what actually exists. So why would there be a difference in the inventory that was actually available at the store versus what is shown on the books? Things like theft, errors, any other types of mistakes that might have come during any of the time during which inventory was recorded, or throughout the period. So some ways that we can continue to protect the inventory would be through the internal controls that you see in the red box. So inventory tickets, you want to have segregation of duties, meaning that the people who are counting the inventory during the physical account of the inventory, they don't normally have responsibility over inventory. So this will be employees maybe from another department come in and do the inventory count for a department that they're not usually over. Inventory counters make sure that products exist, the amount of them, and what condition they're in. Make sure they're not damaged. Then have a second count of the inventory so that a manager can then confirm that all items have only been counted one time. Inventory costing methods. So typically when inventory is purchased, costs do not stay constant throughout the year and over the years. One of the reasons is because of inflation. It can also be because of supplier issues, the economy. Basically, over time, what we see is that costs increase over time. And so there are certain costing methods that businesses use to account for their inventory. So we'll discuss those here. The four main inventory costing methods are shown here. Specific identification, first in, first out, which is called FIFO, last in, first out, which is called LIFO, and weighted average. You can see in the pie chart basically which of these are used most often. Specific identification means that a cost is attached to one item, one specific product, and usually that's something that has either a serial number or a VIN. So usually these are larger ticket items that you can actually track. The rest of the inventory costing methods have more to do with products that are exactly the same, so things that are mass produced. You order them several times throughout the year. You can't tell one product from the other. They're mass produced, they look exactly the same. So the other costing methods make more sense when you think of them in that way. So FIFO is the one that makes the most sense in terms of the physical flow of the products. So first in, first out. That means the first products that you order, that you purchase, those are going to be the first ones that you sell. So they're the first ones in, they'll be the first ones out when you make a sale. This makes sense in terms of perishable goods. For instance, milk. If you are a grocery store and you purchase an order of milk, obviously that purchase will expire. So you want to make sure that you get all of those sold first before you start selling any of the newer milk that has come in. Last in, first out is the opposite of that. And this is not in terms of the physical goods themselves. I just wanted to give you an idea using first in, first out and the milk. So these are assumptions, and I'll explain that in just a minute. Last in, first out, you would be looking at the cost to you of your most recent shipment, and you would apply that cost to your cost of goods sold as you sell products. Then there's weighted average, where you take basically an average of the costs for all of your inventory of that particular product and just use an average to allocate the inventory costing. So here is a description of each of those again. So specific identification, there is one specific unit. That unit is identified by its VIN or by its serial number. So you can very easily track the cost of that product, that particular automobile when you sell it. It's different when you have mass-produced goods. So with first in, first out, the first units purchased are assumed to be sold first. And then the ending inventory would be made up of your most recent purchases. And this is just in terms of cost. This is all on paper. This is all numbers. This is not assuming actual products that you're talking about. LIFO would be when you assign the cost of the last units purchased to those that you sold first. So it's the opposite. And then weighted average, like I said, is you take the average of the cost of all the units. We call it a weighted average, and you'll understand why when we go through that example. So with first in, first out, the costs that are included in the cost of goods sold, they're going to show up in the order in which the purchases actually took place. It will coincidentally be the same as the physical flow of the merchandise that's actually being sold. And here is the example about the milk. Last in, first out is the opposite of that. You are assuming hypothetically on paper that the purchases that you have made most recently, so the last in, are going to be the first out or the first to be sold. So last in, first out. The last ones you purchased, those are going to be the first ones that you sell. LIFO does not make sense in terms of physical flow. We don't really do that. Typically, in terms of physical flow, actually selling products, you do that based on first in, first out. LIFO became popular because it actually gives you, in terms of accounting, it gives you better tax benefits usually. Because if you think about it, like I mentioned before, over time, costs increase when you buy merchandise. So if the business assumes the most recent costs of the products that they've purchased will be the first to be sold, that's going to result in a higher cost of goods sold than with FIFO. So when you're looking at income tax world, you want to have higher expenses on your books to be shown, because then that means that you have a lower income to be taxed. So really, LIFO is most popular for income tax purposes. Then there's weighted average. So it's in the name, average. We take an average of the cost of the purchases, the average cost of all the products in inventory, and use that to determine cost of goods sold. So this is just a visual from the textbook that shows a description of the inventory cost flow assumptions. One of the things that I want to point out here is that you can see as the business is making purchases of inventory, you can see the price fluctuations here. So May 1st, they purchased an order for $45. May 3rd, that went up to $65. May 6th, went up to $70. So you can see that costs are increasing. And that's across the board here. We're using the same numbers for each of these examples. But what you'll see when you look at cost of goods sold is that it will be calculated as a different number for each of these three assumptions. That is okay. The important thing is that once a business chooses which cost flow assumption that it's going to use, it has to continue to use that cost flow assumption over time. So that way, they just pick one and stick with it. They can't go back and forth and pick and choose which one they want to use. So when identical items are purchased at different costs, like we've just talked about, we have to determine which costs will be recorded as cost of goods sold and which costs will stay in inventory. So like I said just a minute ago, once a business picks the inventory cost flow assumption, they stick with it. So it doesn't have to follow the actual physical flow of the merchandise. In theory, they could use LIFO for their physical inventory flow. So like the grocery store, first in, first out is how they're going to sell the actual products. First in, first out, because those objects are perishable. They need to make sure that they sell them in the order of their expiration date. So they sell them first in, first out. But because a business is free to choose its cost flow assumption, they could actually calculate their cost of goods sold and inventory using LIFO.